Hello and welcome to the Fat Tail Investment Podcast. I'm Callum Newman and I'm getting my buddy Gary Norden back today because I want to talk a little bit about options. They've become part of my trading set and portfolio management, and I think they should be part of yours too. And Gary is going to tell us why. Now, Gary is a former investment banker, now runs his own capital. He is also an author of the book An End to the Bull, which I think is a fantastic book. I've read it a couple of times. I've got my own copy here, and I'm going to give it to a young bloke here at the office who's keen to learn about shares and trading and all those types of things. I think Gary's is a book that, if you're the same, you should be reading. And even if you've been around the markets a long time, I think it's an excellent resource. I always enjoy talking to Gary. He's been on before. He's very knowledgeable about the markets. He always knows what's going on. And we're going to bring his insights to you today. So here he is, Gary Norden, author of An End to the Bull and hedge fund manager as well. All right, Gary, I wanted to get you on for multiple reasons. I think this type of market that we're having in now really suits to some of the styles and techniques that you talk about. But before we get into that, I wanted to talk a little bit about your book that you wrote some time ago now, An End to the Bull, which we've talked about before. Reason being, we've got a young guy here at the office who's curious to learn about valuation, equities, trading, just wants to absorb as much as he can about how to find stocks and, why they go up, why they go down, market risk, all that type of thing. And he asked me for some books that he might read. And of course, I wanted to give him your one because I, rate it so highly and think it's fantastic. So I'll be doing that today. Now, one of the reasons I want to talk about, and I think we have a great example from today's market, is you talk about the concept of pricing in and how you can trade either against that sometimes, what the market has priced in. And I thought we had an example where the share markets, the equity markets, ran up to the end of last week to the talk that the Fed chair was going to give on the assumption that he would, take either a soft line or he wouldn't rattle the cage too much. They discounted it as not that important. And he came out, he was more aggressive than had been priced in with what he said. And of course, the stock market got absolutely hammered on the day in the US, which flowed through on Monday to Australia. So do you just want to talk a little bit about this concept of pricing in for a guy like Kirill, which we've got here, who's learning from the markets, that concept?
Yep. Yeah, for sure. It's such an important concept, and the idea of market positioning and how market positioning itself influences outcomes. It's one of the more complex areas to understand in a way. And there is a rival thought process, right? So what a lot of investors and traders do is use the other approach, which is, for example, if you use technical analysis or lots of others, which is just the idea that the market is ahead, right? That's the competing kind of idea. The market is ahead. Now that's much easier. And that just says, well, people are buying because it's going up. So if they're buying, you buy it too because it's going up. Pricing in is basically saying, no, they're not buying because they know it's going up. They're buying because they think it's going up, but they could be wrong. And most of us that have worked, I think in a professional level in this industry, we don't go with the idea that the market is ahead. We believe that markets price in. And like you just said, it's a classic example. And it means that, you have to sort of work out, okay, what are people pricing in? Or, you do that constantly, right? And against that, you're always saying, is there anything coming out that could challenge that thinking? And so, classic one would be, earnings for a company, stocks going up, everybody loves it. And then the earnings come out. That's a classic example of when people are going to find out if they're right or if they're wrong. And as you rightly said, Friday was another one. Stocks had run up over the summer months in the Northern Hemisphere summer months. And there was an expectation, I think, amongst perhaps more the retail side of the industry, that the Fed, they'll be aggressive in the short term, but by next year they'll be off, and they'll be perhaps even cutting rates because the economies will slow and they'll be cutting again. And what we saw from Powell was nothing, not even a hint about when they were going to cut. It was just about raise. And of course that, people hadn't priced that in, and there was an immediate repricing of risk assets, equity markets straight away. So that concept of working out what's being priced in and then looking at the calendar to see if there's anything that could challenge that is really important. And of course, as well, that sometimes things come in that are not on the calendar, that is just new information or, some news event that will again hit people. But it's an important concept if to trade to that next level.
It occurred to me too, when Carol asked for the books, you write in this book how you admire George Soros and his concept of, is it reflexivity that he calls it?
Yes. Yep.
Do you want to talk a little bit about that as well?
Yep, absolutely, because it goes hand in hand with the idea of markets pricing in. So the reflexivity is, like I said, that there's an interaction between players in markets. And if we think about that, what I just said about investors, are constantly placing their bets. That's what they're doing. And then, we need to see whether they're right or wrong. Now, if you want to put an analogy that is similar but different, you would say, let's go through a roulette table, right? People place their bets on a roulette table. But the point about the roulette table is that each player's bet doesn't influence the outcome. It doesn't influence each other. So if everybody bets on 24 on a roulette table and 24 comes up, everybody wins and they win a certain amount, right? It doesn't matter how many people, 100 people play 24 or 1, they all win the same multiple. And if they all lose, they all just lose what they've put in. But in the investing, it's a bit different. This idea of reflexivity is that if everybody's bet on something, let's say everybody's bought a stock, and it turns out that that stock is a dog, right? And I actually don't know why we use that expression dog for a stock, because dogs are great animals. So why do we use that expression? And I'm going off topic here, but why do we use that expression that a dog stock is like a bad one? Because dogs are great animals. So I'm not going to use that expression.
Dogs are the Dow.
It turns out that that is a really bad stock. Let's say everybody thinks that this gold exploration company is going to strike gold in a big way. And it turns out they don't. Everybody loses. Now, the reflexivity angle is because everybody's wrong and they all have to get out, that influences the outcome even worse to the downside. If fewer people had bought or they hadn't, let's say those people had leveraged as well. That again, now they've borrowed money. Now they're really in trouble. They get margin call. So reflexivity is the idea that the actions of people in the markets can also trigger the responses, and it can influence the outcome. So markets are not this thing where like a roulette table, where it doesn't matter what people bet. It does matter how people are positioned. If people had not bought stocks in the run up to Powell's comments, if stocks had been sort of unchanged over July and August, they wouldn't have reacted as severely as they did on Friday.
And this ties in too with your known criticism of technical analysis, right? Because if we take the Fed chairman speech as an example, the market was trending up. And of course, other technical traders say, look, the market is trending up, therefore you should be going with the market. And then you just run into a brick wall, right?
Yeah, exactly. So technical analysis, they make certain assumptions. And, I obviously don't agree with those assumptions. One of them is that the market is ahead. So these people have been buying stocks because they know things are good. And, that's wrong in a couple of ways. One, it assumes that people are smart. And we know that a lot of people lose in this industry. So I would never make that assumption. It also suggests that there's a kind of, as Soros has said as well, there's a predetermined outcome. If you say that the market is ahead, that these people have bought because they know it's going up, what you're saying is that the outcome's predetermined. But that's clearly not true. The outcome in the markets is never predetermined. So those assumptions are incorrect. And the other assumption, or the other thing that technical analysis says, is that data and news events and macro is not important, right? It's you can ignore all that. Just look at the chart. The chart tells you where the market will go, and that's not true either. We know that, right? We know that company earnings. We know that things like what Powell said. We know they're important. And realistically, or in reality, all technical analysis is some sort of shortcut that people like because it makes easy decisions, but it's not valid, it's not reliable, it's not robust. It's more complex to sit there on Thursday and say, what's this market pricing in? what could happen, what could Powell say, and come up with the idea of, well, people are pricing a good thing, but if Powell says something that's a bit more hawkish, they could be wrong. Okay, now where do I need to be positioned? That's all a bit more complex. And the other really key point about this idea of pricing and reflexivity and working out how markets are positioned is the idea that you have to be able to create contrarian positions to the market. And a lot of investors and traders are too uncomfortable to do that. And I think, if you are going to, go to the next level as a trader, particularly in what I do as a trader, you have to be comfortable and able and willing to go against the market, to be contrarian sometimes, to say everybody's long this thing. I just think there's a chance they could be wrong. And the point about that is that the payoff, if they're wrong.
I was just about the word payoff was in my mind. As I was about to say, the payoff, of course,
absolutely,
is if sometimes you're right, you make a huge gain.
Exactly. And sometimes you don't even say, I think this stock's going down. Sometimes you just think you can work out, well, the payoff, if that happened, would be such a good trade. And you could use, for example, options. I think we may talk about options. But, in that situation, you could look at a put option perhaps and say, if they are wrong, I could get a 8-to-1 payoff, for example. Well, that's just a good trade. I'm happy to take that trade because there is tomorrow Powell coming out and there is a chance that they're going to be wrong.
Well,
so
I can
all
just,
of these things
just as a example of that, literally, I had a couple of puts in my account. I wasn't actively trading that speech, but I can tell you on the Monday when the Aussie market went down 2%, those things went up 200% in a day because the volatility went through the roof as well. And that's just an example of if that hadn't happened, though, of course, the market may have gone up half a percent or whatever, and it wouldn't have been as damaging to that value.
No.
So,
and those options may have lost, 5% of their value on that day, right? Or 10% of their value, or whatever the decay was, and a little bit more perhaps. So that's that payoff, right? You make 200%, and if it hadn't have happened, you may have lost 10%, for example. I've said before, if not to you, elsewhere, that one of the great pieces of advice I had from the best trader I ever worked with and was lucky enough to learn from was, he said to me once, Gary, you'll make the most money on a trade when you have the opposite position to everybody else. And, he's not saying you should always have the opposite position, but he said, when you are short, when everybody else is long, if they're wrong, they're the days that you're going to have those great days. And when I teach traders, what I say is, you need to have that in your armory if you're going to get to the next level as a trader. If you're going to get to a high level, you need to be able at times to be contrarian, to say, you know what, I can have the opposite position here. If you're able to do that and comfortable to do that, that's how you can become like a really good trader. If you're not, and you always just want to go with what everybody else does, then you're going to be okay. But, I often say both in not trading, but also like when I'm teaching soccer and things like if you do what everybody else does, that's the definition of mediocrity, isn't it? Just doing what everybody else does is being the same as everybody else. You're never going to become very good by doing what everybody else does. And that includes just everybody else is buying, I'm buying too. You're just with the herd. And that's, I don't think that's a comfortable place all the time.
Well, just for now, I did want to get on to talk about options because I think they're very important. And I'm learning this as I go. I don't want to make it sound like I'm a great options trader or anything like that because I'm not. But I have traded the index and I've used them to hedge and that type of thing. And now with this experience behind, I think they're so important. And I'll give you an example why. Earlier in the year, about April, May, I have a wealthy friend who's got his account run by some advisor kind of thing. And I said to him, this market is just looking dicey. I don't think, I think you should consider hedging your portfolio. You should set up an options account and write some puts against the market because it just doesn't look good to me. Anyway, oh no, I don't bother. I'm in for the long haul. It'll be fine. Anyway, he's down huge amounts of money now because obviously, especially through June, the market just got absolutely hammered. That's one aspect of options to protect yourself. But of course, you can take advantage of it. Now, at that time, I bought a few as an aggressive kind of player, made some money. I had another crack, lost some. But I just want, from your perspective, for anyone listening who's generally, I think we were talking before that people come on into the industry, they're kind of happy to hold shares, they invest for the long term. I'd say the uplift to the next level, if you like, of options, it all seems a bit too hard for everybody. From your perspective, can you talk a little bit about why you want to have or learn about options and how you can use them, the different ways?
Yeah, no, it's a great point, and I think you've already highlighted one of the great areas for options, which is as a hedging tool. Now, hedging is something that a lot of investors don't do and are not comfortable with it, but it doesn't mean it's wrong. It's not wrong, right? It's absolutely correct at times. And the way I put it is that consider hedging like insurance. People insure their homes because if their homes, not even if the home got destroyed, but if you had 150 grand damage to your home, you would obviously want the insurance to cover that. You insure your car, and cars are generally far less valuable than homes, but people will insure them. And what I would suggest is that using options as a hedging instrument, think of them as an insurance policy against a portfolio. If you have $400,000-$500,000 portfolio, it's like having a house valued at 400,000. What would you feel like if you had, a 20% drawdown in that and you lost, 100,000 of your 500,000 portfolio kind of thing? Options can be used. So think about them as insurance. You insure other things in your life. Why wouldn't you insure your portfolio? But the other thing about that is that with a car, we insure it every day of the week, right? We insure it for the whole year. Same with our house. But with our portfolios, you don't have to insure it all the time. You can go into a situation like the end of last week and think, yeah, this market's rallied up a lot. I think, there's a bit of data coming out in the next few weeks, few news. Maybe the next couple of months won't be so good. You can become a bit nervous at times, or there's an event happening or whatever. And you can buy options just for the next 2 months and just to cover yourself for that particular event or this particular time that you think, yeah, my portfolio has done very well. I think it's time. It's almost as a in a way, it's like taking profits, but you're just hedging. You're just protecting yourself if there was a drawdown. And I actually think they're very important for that. We've been fortunate the last 10, 15 years that the market has generally done very well. But a lot of that's been down to the fact that when there has been weakness, central banks have come in and cut interest rates, which has helped markets. That we're in a different environment now. Central banks are not cutting interest rates right now. And I think in that sense as well, every investor needs to be thinking this might be different this time, in terms of, there could be drawdowns, and the, US market's down by about, some of them indices by about 20%. So options are a very good instrument for hedging, for protecting your portfolio, particularly from, larger moves. You wouldn't, if you look, most of us will be happy with like a 5 or 6% drawdown, but, 10, 15, 20% drawdowns or whatever, I think people could use them to protect themselves. So they're very good for that. They are also, you can be used as in a speculative way. If you think that, a stock could jump a lot, but you don't really want to buy it, then options are a cheaper way of getting access to upside in a stock. As well.
I wanted to touch on that too, because this is one that I didn't trade, but in hindsight, I thought about it. When the Aussie market here fell into June, there was a stock I was eyeing off. It's quite well known. It's called Regroup, which is the real estate listing point. Reason being was that it had already gone down at that stage from like $175 a share to it hit, I think, about 98. And I was sort of thinking, so I pick it up as a kind of contrarian long-term thing, overall It's got a very powerful position kind of thing. But because at that stage I was worried about the market dropping further, I hesitated.
Yeah.
And so I didn't end up buying. And a couple of months later, it's up 30%.
Yeah.
There was an options trade there to buy a call option on that stock, which gives you time to see what happens. An option to buy the share later on, right? So you can. Yeah. So, and what I mean is, like, even now, I've started buying a few shares that I think are cheap and that. But having some puts, it's like it protects you because the market's so uncertain. Is what I'm saying is, you can sort of be aggressive in one way, but protect yourself in another way.
Exactly. Yeah. And options obviously are a lot cheaper, right, than buying the stock. And you've put a really good example. And there are examples of this during COVID as well, when stocks fell sharply, that particularly when you've got a stock that's fallen so much, you're always worried about buying, catching the falling knife, right? You're always worried about those stocks. And using call options rather than actually buying the stock is a really good way of potentially accessing that upside, of saying, I don't want to buy 10 grand's worth of the stock, for example, but I'll buy $1,000 worth of options, knowing that each option gives you access to potentially 100 shares, but you've bought a lot, you've outlaid a lot less. But, if that stock does rally, the returns are a lot, obviously options, the way that they're geared and can be very good. So that's how you can end up with the same sort of P&L that you would have had from buying $10,000 worth of shares, but you've done it in a safer way. And if you're wrong, then you've only outlaid the $1,000 of options, right? And they have an expiry, and they could expire worthless, but you don't have to hold them till the end. You can sell them before that. But the point is, and particularly when things are falling very sharply, buying call options, for example, is a good way to access that upside when you're a bit worried about it. That it could be further downside. So there's a lot of different ways of using options. And one thing that, we've just highlighted with the two main examples we've used with hedging and accessing, particularly, in weak environments, we've both talked about buying options. And I think that's really important as well, right? A lot of people, the most common use of options for retail traders in particular is to sell them, to sell them, and it's called, in many cases, they call it, referred to as like generating income. It's not. Okay, you will never hear a professional option trader say that selling options is an income generating tool. It's not. Income is very different from selling options. And when you sell options, if you end up making money because the options expire worthless or you buy them back cheaper, you're being compensated for risk. It's not income. If you go to work every day, you earn income, right? That's what income is. You get paid regardless. With options, when you sell them, that's not income, and sometimes, your option trade goes badly. If you sell options, you can lose 5, 10, 20 times the money you put in. That doesn't happen when you go to work. You get paid. You don't have a month where suddenly you've got to pay your boss 20 times what he paid you last month, right?
Yeah.
That doesn't happen. You get paid. So it's not income. And I'll be very wary of anybody that calls selling options as an income. It's not. You're being compensated for risk. You have to understand that risk and then also understand whether you're being compensated accurately. I'm not a big fan of selling options. I think they're better tools to be to use from the buyer side because of the risk reward payoff.
I'm going to use a strange quote here, but there was an AFL football coach who used to talk, Malcolm Blight. There's a kick in AFL footy called the torpedo, right? So it's like a higher risk. You go for the longer territory with a torpedo. And he would say to his players, look, have one crack at it. If it doesn't work, put it away for the day. And I feel with options that they're a tool that should be used very selectively. It's not to say that you get up every week and go, oh, what can I buy options on? And da-da-da-da. Because for me, like, as you get these fantastic payoffs, but those situations only present every now and again. Is that generally how you view the options market? Yeah,
100%. If in both of those examples I've given, either as a hedging instrument or the one like you said with the REA, where you think it's just falling sharply, I don't want to be catching this falling knife, but by the same token, I think there could be some upside. Both of those are not events that are happening daily. So you selectively choose a situation. Sometimes options are just priced too expensively as well. And you sit there and go, I like this thing, but it's not offering me the risk reward. You've got to make sure that it's offering you the right risk reward. But if they need to be selectively used. And if you can selectively use them, they are great tools used properly. But, it's 100% agree with that. Yeah.
I was just thinking, let's step back a bit and just talk a little bit about the market that we're in. It's been, as we talked about before, it's been a tough 12 months for a lot of different strategies, whether it's momentum or long or whatever. There's a concept in finance, a very basic one called a bear market. Now, when the index, the so-called theory is that when an index goes down 20%, we're in a bear market. Now, I can say from personal experience that by the time the XJ200 was down 15% or whatever it was in June, a lot of stocks had already fallen 80%, 70, 60, like they'd been hammered. Do you think that idea of a bear market is even useful?
No, not the 20% number. I think that's just an arbitrary number, right? It's a little bit like the discussion or the argument about in the US in particular about the two negative quarters equals a recession, right? They're just arbitrary numbers in a way. It's not really important, is the US in a recession? Is it not? Doesn't matter. They're creating jobs at the moment. So it's a very different type of recession if it's a recession. Same with the 20%. I think it's an arbitrary number.
Well, that's basically what I'm saying is like, well,
yeah,
hang on, if I've already lost 80% of my money, now you tell me it's a bear market? Well, no,
it doesn't matter. You have to react to your
weeks.
portfolio, right? Everybody has to react to their portfolio and what they're doing. And you're right. If you had a very tech-heavy portfolio, it was very possible you were well down, before that. You have to react to what you're doing. And just because, in the media or someone calls it a bear market now because it's down 20%, it doesn't necessarily mean that things are different from when the market was down 18%, right? It's probably just still as bad. And really, you have to react to the situation that you see and the situation that you face at that moment and react accordingly.
Do you think there's some truth, though? So just in lieu of that, so I'm trying to think of your average guy who's got his a bit like my mate. He's got his portfolio there. He's not really watching it. He's doing his other things. He's retired. Most of us closer to the market already know things are ropey by the time somebody picks up his paper and it's like, oh, it's a bear market now. So the challenge, so if you're listening to this, is like, not everybody can follow the market all the time. So therefore, do you think in general people should either allocate their money to a fund manager and just say, look, it's their job to manage it and we see what happens? Or if they are going to actively be involved in some way, they do need to be following day to day what's going on? Or can you do a sort of in between half and half kind of thing?
Yeah, I'm not sure. I'm maybe as a trader, I'm maybe not the person to ask about that investment strategy side. I think that the usual situation is that when conditions are quite straightforward and easy, anyone can do it, right? And everyone can make money. It's only when it gets tricky that the pros should do better. But saying that, the average investment fund is down this year, and there's a lot of hedge funds even that are down this year as well. So it's perhaps even some of the pros, well, it's true, some of the pros are struggling right now as well. So it is difficult. I do think that sorry?
It's a case-by-case situation, basically, is what you're saying.
Yeah,
you can't generalize.
I do think, no, and I do think you have to be able to identify like where you are, what your portfolio is doing. And that's why I said, like, it doesn't really matter what people say about, are we in a bear market or not? React to what your portfolio is doing, right? What is your portfolio? What is your account doing right now? And react to that. And I do think, like I've said before, like I'm a big supporter and believe that hedging is an important thing. And I think, like I say, I've said before, people hedge their houses, they insure their houses, they insure their cars. They have no protection, most people, for their, superannuation accounts or their portfolios. And I think that's a weakness, right? It gives you a weakness. And I understand people say, but I'm in it for the long haul. But sometimes these down moves, maybe we haven't had one in Australia, but if you talk to people in Japan back in the day and that, they can last for 20 years, right? They can. You can't always say that we're always going to come back, and
and not only that, it's just an uncomfortable position to put yourself in, because theoretically you're in it for the long haul, but like my mate, he logs into his account every most days, and he's like, I've just lost X amount of dollars, and it niggles. It's obviously going to niggle him the whole time until his supposed long-term
absolutely. And as a hedge fund manager, like, one of the things you have to understand, and people that try to transition between managing money for themselves and managing money for other people, one of those transitions is that there is no long term if the short term is really bad, right? For a money manager, if you have 5, 6, 7, 8 months of bad losses, the money will be taken away from you. People are going to, you're going to suffer redemptions, and your fund will close. So, I have to learn that idea of being able to stay in. And, I think I said it in the book there, right? That there's no long term if you don't get through the short term. You can suffer, people can suffer. And I know people, and you probably know, I'm sure people that, for example, 2008 crash, the GFC, I know people that lost everything in that, their whole their accounts and everything. There was no long term for some people, and you just don't want to be there. And so you have to look at all the time, what is my weakness? Where am I weak? And if your weakness is if the market falls or one sector falls, and that's a great thing about the modern markets. Perhaps 15, 20 years ago, harder to hedge, right? Harder to get access to options. But now there's not just options that you can use to hedge. There are sector ETFs. So if you have a portfolio that's heavy on technology, you can hedge that with, by selling a technology ETF potentially, right? And, if you have 100 grand of technology shares, you can perhaps hedge with 15,000 of, in a way of a technology ETF, for example, or options on a technology ETF. There's so many different ways of hedging the weak parts of your portfolio at any moment. And I think, it's always important to say, like, what are you doing, and related to where the market is. And clearly market conditions now are very different to market conditions 12 months ago. 12 months ago, the RBA was saying they're not looking at hiking rates until 2024, right? 12 months ago at Jackson Hole, Fed Chair Powell said inflation is transitory, we won't be hiking next year, right? Clearly, or both parties were wrong, and clearly the situation now is very different. So, I would suggest to people, if your portfolio structure or your trading style, whatever it is the same now as it was 12 months ago, you're probably wrong, right? You're probably not in the right space, because the market is
Which is how those
now.
fund managers, most of them, which you alluded to, were down for the year. They got caught out. They went with the central banks. Interest rates are not going to go up. We'll go long, all these things. And of course, Ukraine comes, oil spikes, the rates go up, and everything gets jumbled up. And of course they get burnt because things change. So that, in terms of strategy, is another thing which you have in your book is, and I think it would be very applicable now, is that when things are volatile and I'm going to say uncertain, they're always uncertain, but extremely uncertain, that the best strategy is to shrink your timeline down and, or so it's the best one, the one strategy, and trade shorter timeframes rather than long ones. Is that fair to say?
Yeah, I think so. I think at the moment, trying to figure out where we'll be in 12 months, as I say, all the central banks were wrong, right? For sure. A lot of money managers. It's like 12 months now, no idea. Look at some of the movements in commodities this year. They've been significant, both on the rally and now on the fall. Where we'll be in 12 months, I have got no idea, frankly. It looks to me, for example, that inflation is subsiding. It looks like that some of those pressures anyway are lower, some of them are not. But I wouldn't be able to tell you with any confidence like what an inflation print will be in 12 months' time. And that's really going to drive where interest rates are, which is in turn going to drive where equities and risk assets are as well. So when you're not sure where things are going to be, then you take risk off the table. You shorten your time horizon.
I'm assuming.
Sorry, position size down. Yeah, take risk off the table. Position size down. So any new investments you would make, you'd probably make them in smaller size than you normally would, because it's just too unclear. So position size down. Use of hedges for existing investments. Shorter term time horizon. Now, and that's particularly for trading, right? You trade a lot shorter. From an investment perspective, I just think it means you just got to reassess more often, right? Is this still right? Because, you could have bought, copper was flying, maybe early this year was, I can't remember exactly when it was, but probably go back 8-12 months, copper was flying. You think, this is great. Now the last 3 to 6 months, copper's down, 20% or something. Completely, environment's completely changed. So you've got to continually reassess what things are happening. Am I still, is this still going the right place to be? Is this still the right positioning to be? And then you can start to, crank up and increase up when things become a bit clearer. I think things are unclear now, frankly.
Well, the interesting, to me is also, this is part of the, not only the risk management, but the opportunity step, because it's like all those things that were sold down on higher inflation. Well, if inflation is cooling off, well, then there's an argument to say, well, they're going to re-rate back up, if things come together. So it's both the Chinese word or whatever it is, the crisis and opportunity is the same thing, yeah?
Yeah, absolutely. And again, that ability to be contrarian, that ability to work out what's being priced in, could they be wrong? I think You know, and I don't know where the market will be in 12 months. I've got no idea. I'm happy to say I've got no idea. And I don't play that game of trying to predict it either. But I think if you go back like 8 or 12 months, it felt like everything was rising in price, right? All the commodities were going up. Every commodity was rallying. You know, we should see in the shops, all that used car thing, even, you know, here in Australia, we all saw that, right? Prices were going crazy, but it doesn't feel that way right now as it did then, you know, and a lot of commodities have fallen 20-25%. So that's a difference. Another key difference with 6 to 12 months ago is the Chinese currency has fallen substantially, whereas it had been rallying since COVID. You know, and basically everything, you know, the world buys is from China. So if the Chinese currency rises as it did by about 10%, the price of everything was going to rise. But now, you know, the last 3 to 4 months, the Chinese currency against particularly against the US has fallen a lot. So there's a lot of things that are different now that were, some of those pressures look a lot less than they were 6 to 12 months ago. But energy prices, particularly in Europe, still look a bit crazy. And of course, they're a big component of CPI, although they, you know, there is a stripped out version, you know, where sometimes it's like excluding energy, which I think, you know, we might get a bit of that in there. So yeah, it's difficult to find out. And you know, I'd say, like you hit the nail on the head before, like there are times to throw all your chips in, and there are times to sort of, you know, bring it in a little bit and become a, you know, I think probably now is one of those times to just be a little bit more careful. And that comes back to, yeah, your goal obviously is to make money and to do well. But your first goal is to preserve your capital, always is to preserve your capital, whether I'm a hedge fund manager, whether I'm just a trading with my own, or whether you're an investor, right? Preserve, stay in the game, stay here. And I've been doing interviews recently. I've been talking about this idea of trading and investing as an infinite game, not as a finite game.
Yeah, I read the article. I quoted you in my recent issue. I thought it was a fantastic point.
Yeah, I wrote about it in my newsletter, right? And it's a really interesting concept, and I think it's one that people misunderstand. And you hear about winning traders and winning. You don't win in this business, right? It's not a winning and losing business. It's not like a football game. You know, I can turn around and say Liverpool won 9-0 on, you know, Saturday night. Yeah, that's a game. They won it. The game's finished. They have won. It can't change. They have won it. This industry, you never win. You just stay in it. That's it. So that's a key mindset of people, you know, and stay in it when others are struggling. If you have that winning mindset, you can often take on, you're playing the wrong game effectively.
I was just thinking, just to sort of conclude, I suppose, this discussion, because we started with Kirill, the young guy who wants to learn a bit more. And it's just interesting listening to you talk there. You mentioned the Chinese currency, and I was thinking to bring up the bond markets because of interest rates and that type of thing. Yeah. So I was, from your perspective, alluding to your book, getting information from multiple markets is important, isn't it?
Yeah, 100%. Yeah. You should be looking across markets for different clues. You know, what are they saying? So, you know, right now, for example, US, right, 2s, 10s bond yield curve is inverted, you know, and because the Fed have moved away out of the bond market now to a degree, okay, they're going to start QT, which is a big factor, right? And it's a big reason why a lot of pros are negative and bearish right now on markets is because of QT. We don't quite know what 95 billion of QT is going to do to markets, but it might not be pretty. But 2s, 10s in the US, you know, inverted yield curve, you know, that paints a negative picture going forward for the US economy. Now, you would say that equity investors ignored that in July and August. But perhaps now they'll start to look at that, you know, and it's when you start to get these conflicting views. And if you just look at the stock
what you're saying
market,
is the bond market and the equity market are pricing in two different things, right? In that situation.
Yeah, exactly. Yeah, the bond market, exactly. They're pricing in two different things. And so you need to weigh that up, you know, and there are times when they're in sync with each other and you can work out they're in sync. You can commit more capital to the equity market. But when you've got markets telling you different things, that's when you need to be a bit more cautious. So looking at, you know, government bonds and yield curves, looking at corporate credit as well, what's happening in the corporate bond market. You might think this company is great, but perhaps the bonds are struggling a little bit. So can you see what corporate credit is doing? And look across a number of different markets. We know, for example, even, correlations, they can be positive, they can be inverse. But we can get clues from markets as well. And that's what we try to find out and try to put a picture together. Not always possible, not always easy, but we're not saying it's easy.
Yeah. So, I mean, just as an example of that for me is the REIT sector here in Australia was absolutely hammered in the last 12 months because rates are rising. And then you get the bond market going, well, maybe that inflation problem is solved, or that could be a tailwind for that sector. It's just an idea that I'm exploring. So that's an example of how that can feed into it. All right. Well, I don't want to tie up because we've held you up too long, but you did mention that you've got a new book on Amazon. Do you want to quickly tell us about that?
Yeah. So obviously one of my key favorite things is to explain to people why technical analysis is such an unreliable form of analysis. A lot of traders and investors use it. It's very popular all over the world, but it's unreliable. And I wrote a book a number of years ago, and I've basically now redone it, rewritten it, updated. It's on Amazon as a Kindle version called Technical Analysis Exposed: Why Most Technical Analysis Traders Lose. And it's basically a step-by-step breakdown of all the flaws, the faults, and they're also using research from all over the world. Some, very robust research, which actually looks at how traders who use it, how they go, and to tell people what the truth is about this. So that's was republished on Amazon a couple of weeks ago. So that's available now as well. And if people like what I say, I have a newsletter on Substack. And most of what I try to do is to sort of, I suppose, to walk people through some of the BS in this industry, right? And just try to correct people, I suppose. And just challenge.
Yeah, and we should say you're totally independent and bring a voice of experience that I don't think there's an equivalent figure here in Australia, certainly.
I just try to tell people things that they might not hear elsewhere. Try to challenge so-called conventional wisdom sometimes, but not just for the point of doing it, not contrarian for the point of being contrarian. I do it backed by, hopefully some interesting aspects and research as well.
All right, mate. It's been an absolute pleasure as always. And we'll catch up hopefully in another 6 months, and we'll see where the world has gone with some of the things that we've talked about. But it's always a pleasure to talk to you.
Thanks, mate. Really enjoyed it. Keep well, and I hope to see you again soon.